Thank you for attending today's webinar titled What's My Business Worth? I'm your presenter. My name is Zach Sharkey. I'm a principal at Gateway Valuation Consulting. I am a chartered financial analyst, a licensed CPA in the state of Missouri, and I also hold the Credit and Business Valuation designation through the ACPA. I have experience, almost 2 decades, in finance, both public and private capital markets. Also the author of Business Valuation for Business Owners. I know many of you have read the book. I'll be referring to it some within this presentation because it discusses quite a bit more that we won't get into in this, but it's a good resource you can find. A lot of libraries are carrying it now, so you can check that if you don't want to buy it. Disclaimer, essentially that this is intended for information purposes only. It's not intended as financial investment, legal, or consulting advice. All right, so before we can talk about the what's my business worth question, we first need to address the reasons for evaluation. And I have put down 3 here, planning related, frictional, excuse me, or regulatory. And I'll say that these aren't definitional per se, these are my terms, so and I'll discuss those in a little bit here. So planning related can include gift tax appraisals for succession planning. Succession planning can have a lot of different reasons. Measuring value creation, executive bonuses, collateralized stock loans, etc. I lump these 3 together because they are covered in Business Valuation for Business Owners. There's a lot that goes on with that, particularly with the Business Owner Solution, which is the last or one of the last chapters of the book. But these are the reasons. And when I say planning related, I mean that the valuations are done for a cause, for something that is anticipated. For example, succession planning, we're trying to bring on the next level, the next generation, family generation to run the company. Those types of things. Buy-sell agreements can be they can be planning related. They can also be frictional depending on how they're constructed. Frictional appraisals, and when I say frictional, I intend to mean that these appraisals are usually not planned for, and as you can see, divorce, that's something where you usually have 2 parties looking to get to different value conclusions. So they're not really harmonious, they're more frictional. Shareholder and economic disputes, obviously anything with a dispute will be more frictional. And finally, regulatory appraisals. And these are where a governing body, it could be the IRS or FASB, requires it. Estate tax valuations would be one. So if a person passes away with a taxable estate, they own a business that's not publicly traded, the IRS will want to know what the value of that company is worth. A valuation will be needed for that. Fair value accounting purposes, there's several here, but I'll give an example real quick. For example, if a publicly traded, we'll say a technology firm, acquires a privately held technology firm and they pay $10 million for it. We know that they have about $2 million in cash, $1 million in computers and stuff, tangible assets. But there's about $7 million of stuff they bought that we need to find out what is it. There are 2 types of what they call intangible assets. There are identifiable intangible assets, and that's where the valuation will come in and value what the value of those identifiable intangible assets are, and then the residual, that's called goodwill. So on today's agenda, I have 2 parts. The first part are the approaches of value. We're going to cover the income approach, and below it are the various methods. The market approach, and again, the methods are listed below. And finally, the asset approach. And what's not covered in this is the excess earnings method, and that's a hybrid between the asset and income approaches. I'm going to cover it in a future presentation, but there's a lot to that it kind of deserves its own due. Second, part 2, we're going to cover levels of value. There are four, I mean, there are actually many more than four, but there are four broad ones. And again, I cover this in business valuation for business owners if you want to really know a lot more about the levels of value. The top would be investment synergistic, then control value marketable, minority marketable, minority non-marketable. The one that if you're going to buy and you can see the publicly traded equivalent by minority marketable, if you're going to buy, we'll say 100 shares of Apple, that would be the level you're at. So just to give you an idea of the differences, and that is a hierarchy. So in terms of value, there's only one lower than that. That's minority non-marketable. That's what a lot of privately held firms that have minority interest, that's where they're going to be at. So approaches of value. First one is the income approach, and we're going to talk about the numerator. Income approach consists, I mean, at its core, a numerator and a denominator. In most cash flow models, at least the ones that I use free cash flow. The numerator is free cash flow. Free cash flow and accounting cash flow are often mistaken for each other, and a lot of times you'll hear EBITDA as being cash flow, or people will just say cash flow and not really say anything more than that. EBITDA is not free cash flow. It's a form of accounting cash flow, I would say, but it's not free cash flow, and there is a difference. It's in quality and reliability of the information, and Enron is a great example. If free cash flow would have caught a lot of that stuff, that was accounting tricks to hide a lot of what they were doing with Enron. Accounting cash flow is a lot of noise that free cash flow cleans up. It's much better quality. Accounting cash flow, so to speak, can in addition to EBITDA, could be operating cash flow from the cash flow statement. I've seen and I've heard many ways of how people say just cash flow. It's a very popular term. It's thrown out, and it's not. It needs to be defined better. And there's two types of free cash flow. I don't want to harp on this too much. Free cash flow of the firm, that's a control level or invested capital. So this is for the entire firm. And it's relevant when calculating the entire enterprise. So the value to all stakeholders, not just stockholders. And we're going to talk about this here a little bit more in a second. And then free cash flow to equity, and that's the amount for common stockholders. So now next we're going to talk about the denominator in the income approach, which is the cost of capital. The first one, and I'm going to pair these, there's two we're going to talk about. Free cash flow of the firm, we just talked about that a second ago in the last slide, divided by the WACC, or weighted average cost of capital. And if we're valuing the entire company, we need to match FCFF, free cash flow to the firm, because this is the entire firm, so all cash flow attributed to the firm, with the weighted average cost of capital, WACC. That's the cost of the entire company, not just the stockholders. And if you're really interested to know what the WACC equation is, or learn more about the WACC and beta, you can Google it. There's tons of information on it. The resulting level of value, this is important, of a free cash flow of the firm to WACC it's a control level of value. So just remember that. The second one is free cash flow to equity divided by the cost of equity. So now the first one, we had free cash flow to the firm divided by the WACC, which applies to the firm. Now we're at free cash flow to equity, so cash flow to equity holders divided by the cost of equity holders. This is important. We have to keep these aligned. Cannot mismatch. When valuing the equity, again, and only the equity, the appraiser may discount the FCFE by the cost of equity. And it represents the risk or opportunity cost of the company's equity, and again, only the equity and common equity here. There's many approaches to determine the cost of equity. I'm not going to get into that today. It must be matched with FCFE must be matched with cost of equity. Can't mismatch, as I said. And this last point's important. The resulting level is a minority level unless control adjustments are made to the numerator. So if control adjustments are made to the free cash flow to equity, then you switch from a minority to a control. Control is not found in the denominator, it's in the numerator. So that's an issue where some appraisers run into this problem a lot. I cover it again. I don't mean to harp on the book, but Business Valuation for Business Owners talks about it quite a bit. So the first method, or the income approach we're going to talk about, is the discounted cash flow method, or DCF. You've probably heard it that way. And what that does, it projects future cash flows, free cash flow, and discounts the free cash flow to the present. So several years, usually 5 or more, maybe forecasts, and it depends on when a steady state of growth is expected. Many business owners don't know what's going to happen in 3 years, and that's pretty common. The traditional business valuation approach that you'll see will project out 5 years in a DCF. That's just pretty common because the visibility is unclear. However, it should be done until what they call a steady state or long-term sustainable growth rate is projected to be reached. So what that means is if you're expected to grow at 5% year one, 3%, 7%, it's supposed to get kind of, bumpy or down or up. And then at, we'll say year 8, it's going to grow at 3%, where it's going to grow at 3% every other, each year until perpetuity. They should model out every year until you hit that long-term sustainable growth rate. The projected cash flows are divided by the cost of capital. Again, it depends on what we're doing here, the WACC, or cost of equity. And time value of money is captured in the denominator for each cash flow projection. And if you're not familiar with time value of money, it's the concept of $1 today is worth more than $1 tomorrow. The reason being is you can take the $1 today, go to the bank, get, we'll say, interest of 2 cents. So tomorrow you have $1.02. Whereas if you didn't invest that $1, tomorrow you just have $1. That's the whole thing of time value of money. Typically used when the company's future projections are expected to differ from historical results. So if they're not supposed to be the same, you're not in that sustainable growth rate yet. But yet a steady rate can be ascertained with some certainty. So we can say, okay, in 5-6 years we can hit that. Kind of continuing on here with the DCF method, it's often preferred tool. This is what I use for, I would say, the majority of my appraisals, just because the firms are either growing or they're usually growing, or they can say with some certainty that they're not going to grow at the exact historical rate, or at 3% year 1, year 2, year 3. They'll be like, okay, we know we're going to grow at 7% next year. And it's 8%, and then it's going to drop to 3. Then it usually gets a little cloudier, but it's used a lot when they know what's going to happen in the future, when they have a pretty good idea in terms of visibility. And because of that, you really need a background with valuation, econ, and finance, because it can be really complex. It's not something easy. If you're not familiar with it. So these appraiser using a DCF method should have a sound understanding of econ and finance. There's a lot of adjustments that need to be made, changing capital structure. What that means is if the balance sheet is going to change from more debt to more equity, vice versa, you need to account for that you have to kind of look at 2 parts. One is the growth in the income, but also how you're managing the balance sheet. So you have to account for both of those, and required working capital kind of goes in with that. Valuation software. Valuation software has come on the last few years. I've seen it it kind of came on it strong at first, but it's softened up a bit. The problem with valuation software, it's I guess, to give the best example, it's like TurboTax. If you want to do your own taxes, you can you can plug it in and you can do it yourself. The problem is, from a valuation perspective, if you aren't like every other company and you need to make adjustments and conform to you can't do it with valuation software. There's limits. So you need expertise to do a DCF method. If you use valuation software, it's just going to ask, again, like TurboTax, what's the company year's growth rate that's supposed to be in year 1, year 2, year 3. They just plug it in. But if there's all these adjustments that need to be made, which almost every appraisal needs many adjustments, it doesn't work. But no matter what the DCF method used, the result is garbage in, garbage out. The value estimate is only going to be as good as the input. So if you say the company's going to grow at 10% and it only grows at 5%, I mean, it's going to give you a value based on 10%. It can be the best model ever, but if you're feeding it garbage, you're going to get garbage out of it. So a second method under the income approach is the capitalized cash flow method. And this is simpler in use and application. And in the direct application of this, you have one numerator and one denominator. There's no projections or forecasts. There's no real discounting. I mean, you're really just taking it's called the Gordon growth model. You're taking they call the year 1. So you would add next year's growth, which is supposed to be the growth that you'll have every year forever, divided by a denominator. The denominator could be a cap rate if we're doing cost of equity. Cap rate's your cost of capital minus the long-term sustainable growth rate. And it's similar to what's used in real estate appraisals. You've probably heard cap rate before. You can also use the WACC if we're valuing the enterprise. And again, the numerator must match. It can't be an equity, free cash flow equity. It needs to be something to the firm. It's used when a steady state of growth has been reached, isn't expected to change. Also used in some frictional cases where the DCF method isn't allowed. And I point out divorce in particular because a lot of divorce courts will say, in a DCF, we're looking at the future. Well, that hasn't happened yet, so we can only look at what's happened to today. A capitalized cash flow method does kind of cut off what's happened from today, and we're going to use what's already happened and use that information to value the company. I'm not going to say anything about this because I have my opinions on it, but that's where it says. It's the capitalized cash flow method is much simpler. It's less complex. A lot of CPAs. I'm a CPA. You don't learn really much in valuation, finance, or econ with CPA. But I could see how this, if you only have the CPA, would be great. I mean, it's pretty easy. Don't need a lot of finance to understand it. So and from what I've seen, a lot of CPAs without that they favor the CCF method. Just doesn't require as much finance and econ expertise as the DCF H model. Speaking of the H model, that'll be the next one we talk about. H models and other approaches. These are more complex to non-finance and econ practitioners, and honestly, most don't even know what they are. I've only seen them used by other CFA charter holders and PhDs. The H model, it's similar to a DCF, and it applies when a level rate of growth decay is expected over a specific period of time. So for example, if growth, it's usually for high growth companies now that are going to grow at a linear rate, which means an even rate, steady rate over, we'll say 6 years, and then continue forever. And I think I give, for example, growth is expected to decline at 2% annually over a 5-year period, then progress at a steady state or long-term sustainable growth rate. The H model is excellent for accounting for that, but it's kind of an offshoot. It's a type of a DCF method. Residual income model, this is different. It asserts an equity charge that accounting income doesn't account for. And it uses residual income and not free cash flow. If you've heard of EVA or EVA models or EVA, this would be where that would come into play. It's more relatable to that. Examples of these approaches can be found at gatewayvalue.com. All right. Now to the market approach. You can see I have highlighted in red 2. We're only going to cover the first 2. The latter 2 are pretty explanatory. So 1 and 2 we'll cover. Number 3, recent transactions of the company's stock. That could be used when there's arm's length transactions of a company's stock. That's pretty easy because that's a market that's been made. Number 4, bona fide offers to purchase the company stock. If these are legitimate offers that are arm's length, again, that can indicate the value using a market approach. So the first method of the market approach that we're going to talk about is the guideline public company method. And this uses multiples of publicly traded companies to determine a private company's value. The guideline public companies chosen must have economic equivalence with the subject company, which often means the same industry with similar characteristics. They're not always the same. Ideally, you want companies who are your competitors. You probably have a 10, 20, 10 to, we'll say 10 to $100 million in revenue, maybe smaller, maybe more. And these publicly traded firms have possibly billions in revenue. So it's not, and a lot of times they're not pure plays. You may be a pure play doing one line of service. They may be conglomerates with, 7 lines of service. So what we try to do is find companies that share the same pain, I guess, the same pain and rewards that you have. And here's an example using just one multiple, and this is we're going to use EV to EBITDA. So we're going to assume the guideline public companies have a trailing 12-month enterprise value to EBITDA ratio of 5. And enterprise value is the value of all capital, so both debt and equity. Your company's trailing 12-month EBITDA is $1 million. Using this method, and just this one multiple, the calculated value would be 5, taking the multiple from the market times 1 million, which is your EBITDA, and that indicates a $5 million enterprise value. And once again, enterprise value includes all suppliers of capital, and equity value is net of all suppliers of capital. So if you wanted to get the equity value of the entity, you would subtract out. Most privately held firms just have debt. Some have preferred stock. You have to subtract out those. To continue on with this method can be combined with other approaches, notably the income approach. So you can weight, and it's pretty common to weight, for example, this with the income approach, 50-50 or whatever. It depends. A lot of judgment is involved in that, professional judgment. This provides market level values of publicly traded companies. Uses publicly traded shares, common equity, and this is important. So the level of value is a marketable minority. Now, here's some problems that I have, or problems not I have, but problems with the guideline public company method. Probably the biggest one, or one of the biggest ones, there's a couple, is size. The publicly traded companies that you can go out and find, they're public for a reason. They're usually quite large. And it's hard to compare a company with, I have 2 million on here, but even you can imagine a $50 million company being compared to a $50 billion company or $5 billion company. So there's a size disparity. Raising capital, you can't just go out and offer debt right away, whereas these publicly traded firms can do that. And again, there we go, access to capital. So your capital structures, the capital structure is managed quite differently. Privately held firms are usually looking at the balance sheet. They don't want a lot of debt because the owners are usually the ones who are running it. You have employee owners. That is, and I'm going to talk about this in a second, that differs a lot from management. Management of publicly traded firms are usually not the owners. They're not the founders, and they're more income statement focused. They're worried, they're concerned about hitting their incentives, whether it's, some target of profitability. It's just a completely different view of how they manage a company. One's more balance sheet, one's more income statement. And there's a really good book called Private Capital Markets by Robert Slee. If anyone's interested in learning more about it, I highly recommend it. And it really discusses the difference between private and publicly traded firms. The markets are much different. They operate much differently. And the companies within those markets are driven much differently. So the next second method of the market approach we're going to cover is the guideline company transactions method. And this is really similar to real estate appraisals because it uses comps of completed transactions, guideline company transactions. And we appraisers use multiples of these acquired companies to calculate value. So it's kind of, I guess, going back to the, the real estate analogy. If you looked at a house that's being appraised, they're going to look at houses in your neighborhood, in your town, that are similar to yours, and they're going to use the price per square foot times how many square feet of your house, and that may be a value, and they'll try to find a couple comps. That'll be the price of your home. It's pretty much the same thing here. That's all this is. And again, here's an example using just one multiple. We'll assume a transaction had a market value of invested capital. That's the term in this method that's equivalent to, or pretty much equivalent to, enterprise value. They had an MVIC to sales ratio of 1.5, so that's the market data. Your company's trailing 12-month sales is $3 million. The calculated value would be 1.5, that's the transaction that's taken from the market, times 3 million, or $4.5 million market value of invested capital. Again, that includes all suppliers of capital. We'd have to subtract out everyone else to get to the equity value. Like the guideline public company method, it can be combined with other approaches and methods. Provides market level transaction values because these are more comparable typically to your firm as opposed to a publicly traded company. Because it's for 100% of the company, it's controlling level of value. So this is not minority, this is control. The data comes from subscription services and is not as readily available as publicly traded company data. That's one of the downfalls of it. And these are some of the problems. Problems include finding adequate number of transactions within your industry that makes sense because, for example, I pay a lot of money for the service that I have to get these transactions. The company has to go out and find intermediaries who are willing to share this information. So there's some biases there, but it's hard for them to get. So getting enough of those can be hard. Statistical biases, because there are more than one provider of the transaction data. Some appraisers will subscribe to more and download, say, for example, transactions by a certain industry code and will not eliminate overlap. So you have double counting on some. So you have to, well, there's some problems with that. Obviously, if you double count anything, it's going to throw it off. Making adjustments to the data can be complex, and it really requires a high degree of skill. And I just want to add this: the new tax laws for pass-throughs, which allows the 20% deduction for a number of different companies, different industries. That's going to be for another webinar, but that's another thing that when we're taking companies that were not allowed that deduction to companies that now are, that will need to be another adjustment. So the third and final approach evaluation we're going to talk about is the asset approach. The asset approach is used primarily for holding companies and entities where the value of the underlying assets exceeds their earnings ability. So under the adjusted asset approach, or the net asset method, the assets and liabilities are calculated at their current values. So what we're doing is we're taking the assets, we're taking the liabilities, and we're writing them up to their current values. So if you have, for example, real estate's for accounting is held at cost. We would have a valuation of that, and it would be its current value. The liabilities are then subtracted from the assets, and the resulting value is control level of the equity. And if the assets aren't liquid, so liquid being cash, stocks, bonds, a discount for lack of liquidity is sometimes used to account for the cost of liquidating the assets. Liquid assets have low cost. You can trade stocks for $5-7. Non-liquid assets like real estate, machinery, equipment, things like that, they have high transaction costs and also opportunity costs. So that's where the DLOL would come into play. And finally, we're going to talk about the levels of value, part 2. And I know we're running short on time here, so I'm going to try to get through this as quick as I can. This is from the book, Business Valuation for Business Owners. There are more levels, but these are, I would say, the general 4. Valuation discounts are used to move down not up, down, that hierarchy ladder. There are two primary types of valuation discounts. The first one's a discount for lack of control, and the second one is a discount for lack of marketability, which we'll discuss here shortly. Levels of value are critically important, very, very important, but they're often neglected in governing documents. In governing documents, I mean by that, it could be your operating agreement, your partnership agreement. I find it's a lot in buy-sell agreements in particular. It's whenever a transaction is needed, it's the document that guides the process and helps determine the price. The level of value is rarely stated, and if it is stated, it's not specified, if that makes sense. And I'll show you a good resource here in a second to help you along with that. But to give you an example, a 10% owner could be treated the same as a 90% owner without specifying the correct level of value. A 90% owner most likely having voting effective control of the company, and you have 90%, and the control has value. Likewise, a lack of control has diminished relative value. So there's value in having that, being able to say, we can, when you can call the shots, when you can almost liquidate, you might even be able to unilaterally liquidate the company, whereas a 10% owner, you don't have that. So there's a difference in value there. And the article I was talking about that really hits this, it was an article that was published in the Missouri Society of CPAs magazine called The Asset, and I have it on gatewayvalue.com/other resources, just to show you how important it is to specify that. Second part of levels of value, most acquisitions, so acquisitions, not transactions, are done at the investment synergistic level of value. And again, this is the highest level of value. Control level of value has degrees of control. You have complete control to market, liquidate, and operate. So if you have, we'll say 100%. You can do whatever you want. Then you also have control, we'll say 51%, greater than 50%, where you probably can't liquidate the company. You may not be able to make major decisions. You probably can't make major decisions. You may be able to do some, but you definitely lack the different, or you lack the abilities that 100% has. So you both have control, but there is a difference there in terms of the value of control, the levels of it. The next one is a minority marketable level of value. And this is, again, similar to owning shares of publicly traded stock. Going back to the Apple stock, you can vote as a shareholder, but your vote really doesn't mean much because Apple has about 5.1 billion shares outstanding. But the shares are marketable. So here we have minority marketable, and so focus on that second word, and we're really going to talk about it in a second. They're marketable because you can buy or sell the stock, trade date plus 3 days later, receive your cash. You know what you're going to receive. The transaction costs are low. You have execution certainty, and the transaction is going to settle. And here's the lowest level, minority non-marketable level of value. And if you're minority level, this is the most common for privately held firms. As a minority level interest owner, you can't control company decisions. If you own 10% of a privately held firm, there's probably little or nothing, assuming they're all voting shares, you can do nothing. Most closely held minority interests are restricted with transferability. Non-marketable, and the non-marketable is really the biggest part here because, as we'll talk about the discounts, the discount for lack of marketability is usually much larger. Non-marketable just means you can't sell the interest quickly, if at all, and the costs are high. So you have high expense to sell, if you can sell it at all, and the opportunity costs to market it and go through the process that the governing documents have put out for you. And I like to kind of give this analogy that these could be, I've seen some that could be equivalent to the value of a rock. If you think of it, if you own, say, a 3% interest in a privately held firm that has never paid dividends, is not going to pay dividends, and is going to run into perpetuity, you're never going to receive anything from that. A rock, on the other hand, you have a tangible product. I know it's a silly analogy, but it can actually be, depending on the company, if the company is profitable, and it's a pass-through and you have to pay tax on it. It can actually be worth less than a rock. And I've seen those too. Gifting programs usually dump this level. The lower value of interest gifted because of higher valuation discounts, less tax paid. As of today, in 2018, you can gift, I believe it's $14,000 per person to as many people as you want tax-free. So that does not just include cash, that can include stock, and that's why a lot of people will subscribe to these gifting programs and gift stock using valuation discounts to kind of push through more stock and not be taxed. So levels of value. Now we're going to get to the first type of valuation discount. Discount for lack of control. And again, this is used to move down the levels of value ladder. These are also called minority discounts. Excuse me. They're not readily observable for most asset classes, so they're mathematically implied from controlled premiums paid, which can be observed. And if you are interested to know the calculation, I put it there for you. DLOCs account for, like I said, the lack of control. I mean, kind of as stated. But what it is, it's an economic concession that's demanded by the buyer to purchase the asset stemming from the lack of control. So again, going back to the 10% owner versus 90% owner, if you can't control anything, if you're not getting paid distributions and you don't see any coming, I mean, there's a huge premium there that can be warranted. It really depends on the asset class and the circumstances, but that's essentially what that is. The second type of valuation discount is the lack of marketability discount. And these are often way more significant and subjective to measure. The ways to measure DLOMs have been contested in many courts many times for many years. And there is no universal method. No matter what method is chosen by the appraiser, great care, thought, and support to justify the discount is required. These are usually tested with the IRS, where some appraisers will get a little aggressive, sometimes for good cause, sometimes not. Regardless, I'm not taking a position there. They need to be supported because this is where you can really take a bite out of value. And when it comes to gifting, and we don't want to have a high value when we're gifting shares, or most people don't, because you want to get as much as you can without paying tax. DLOMs, some appraisers get aggressive to do that. Private company agreements, so the governing documents lay the groundwork for determining the size of the DLOM. There's also other parts, restrictions on transferability. Obviously, we're talking about marketability, history and right to receive dividends, distributions, or other liquidity. These are all also meaningful. There's other ways, other criteria for measuring it, but these are some of the major ones. Because we're talking about marketability, liquidity, if you have a company that's paid distributions for the last 10 years that are in excess, and we're assuming this is a pass-through entity, they're in excess of the tax liability, you're probably going to have a lower DLOM than one that does not pay anything, all else equal. That's kind of what we're getting to here. And kind of the finale here, I know, we didn't talk much about the levels of value, and I kind of had to rush through this a bit. Business valuation for business owners, not trying to pitch it, go to library, get it on Amazon. You can do it if you're part of the library program they have there, you can get for free, but I encourage you to read it, read about them, because it is really important for business owners and advisors, attorneys, and CPAs to understand this stuff. But for income-based approaches, the level of value is determined by control adjustment to the numerator of the free cash flow. So it's not denominator, it's numerator. It's adjustments to the numerator. Again, but if we're talking, going back to matching, we also need to match as well, the numerator denominator. But control is determined the numerator. Control and normalization adjustments are not the same. And I'm going to talk about that in a future webinar, probably coming this summer. DLOCs are typically smaller and much smaller than DLOMs and less controversial, whereas DLOMs are more subjective and are statistically larger than DLOCs in most cases. And because of that, DLOMs usually require more support quite a bit of it. And some final thoughts here. New tax rules have value implications that didn't apply in previous years. Lower tax rates for C corporations, increased deductions for certain pass-through entities, and both these result in greater cash flow, all else equal. The 20% deduction for pass-through entities is what I'm referring to there. Valuation is both an art and a science. You can't plug and chug or use a rule of thumb if you want to get a good number, and if it's going to regulatory or divorce or something of that nature, you definitely can't just determine a number. Valuations for divorce purposes are governed by the jurisdiction state, and the rules differ. And I really want to hit this in finale. Divorce is determined state by state, and each jurisdiction differs. And there's a lot more if you're watching this webinar or tuning in, and because you want to learn more about this for divorce, I will tell you that it's going to vary on what can be applied on even the different types of, when I talked about the market approach and the one multiple I use, there are some states that forbid certain multiples from being used. So you really, if you're going through divorce, talk to your attorney. That's all I'm going to say, because it varies from state to state. And along with that, this is for informational purposes only, not intended as financial investment or consulting advice. If you'd like some more information, you can visit the website gatewayvalue.com. There's plenty of resources there for you. You can email me at zsharkey@gatewayvalue.com. You can call my office at 636-695-4814. And that concludes today's webinar. I know I'm a bit running a few minutes late. But if you have any questions, feel free to call or email me. The previous slide, this should be recorded, so you should have that. Or you could visit gatewayvalue.com, and a lot of your answers or questions can be answered there, or you can get my contact information there as well. Thanks for tuning in, and I look forward to presenting again soon.